Thank you for being here with us. This is our Ask the Expert series here at Doma. We're talking today with Travis Lemmon, who is the owner at Creekside Mortgage. So he owns Creekside Mortgage. He's been in the loan office world for a really long time. I've known him for a long time as well. He's just joined us recently at our sales kickoff event as well, and we love working with Travis. So we're excited to be here with you today to talk about pipeline, how to build pipeline in difficult environment, which is sort of what we're facing today. And so Travis, would love to pass it to you for just a few moments to hear about you and your background, and just thank you for being here with us today, and look forward to having this session with you.
Yeah, no, thanks, Stefan. I appreciate it. Yeah, it's been a journey. As far as my background and history here, I mean, I grew up in Southern Utah, small town in Southern Utah. I literally remember, one stoplight, and I remember when McDonald's came to town, and it wasn't that long ago. So my family's all entrepreneurial, and so I knew I always wanted to do something kind of entrepreneurial, owning my own business, different things. I went to BYU, studied corporate finance. I thought maybe we would go the Wall Street route. But when I came out of BYU, it was right during the financial crash. And so there was just no jobs. And so I kind of fell into sales. I think a lot of people in sales kind of find themselves falling into it, but did that, realized I kind of liked it. I was kind of good at it. And with a lot of people in real estate, whatever arena, I feel like you again fall into it. It's almost an accident. And that was my situation. I had a friend that knew another loan officer that needed help. And so I went on as a loan officer assistant and went that route. And it was supposed to be a 1-year commitment, and ended up being like 6 years. Learned a ton, did a lot of production under someone else, and kind of learning their systems and processes. And at one point, I just kind of thought to myself, okay, do I want to be an assistant forever? The answer was no. And so I made the jump to go out on my own, and did that for a few years. And then that rolled into, okay, I want to own my own, and did that. And anyways, yeah, here we are. It's been great.
Awesome. Well, sounds like a cool journey for you, and I know for your family as well. So thank you. Thanks for joining us. We're excited to hear about your expertise in this space. I know that you've had a lot of changes, and so it'll be helpful for others that are on the webinar today to learn from that. But again, thanks for joining us. What we're going to go through today, for those that have joined, is we're going to look at the changing environment. So we're going to look at two bookend events, one being the recession of 2008 leading up to the pandemic of 2020. From there, we'll talk about mindset shift from just 2021 to 2022. So as we all know on this call, the last year has been crazy on both sides of the fence. We saw this major boom. Now we're seeing rates hike, and we're seeing sort of like either a plateau or maybe coming back down. So what's the mindset shift there in just these last couple of years? Then we'll look at 2023 and beyond. What is future proofing look like for your business? Balancing pipeline, and these are all questions I'm going to be asking Travis. So I say we're going to talk about it, but I'm asking Travis the questions. He's going to give us his expertise, and then finally we'll talk about just foundational best practices. So we're looking at this year, last year, this year, the future, and then we'll look at just what's the overall foundation that has helped Travis and his company survive and thrive through these changing times. And again, as we mentioned at the end, we'll have a Q&A session that we'll be able to answer your questions, or Travis will answer your questions specifically with the last few minutes that we have. But from here, let's go to the changing environment. So here's a graph of what has happened in the last 10 to 12 years. So in 2008, we know that's when the recession kicked off, and it was all sort of led by the housing market. There was a crash there, and that meant banks, fintechs, small community banks had to rethink what they were doing, how they were approaching the customer. If you look in 2008, you'll see that the setup was about 25% credit unions, community banks, small banks. 50% of the market share was in the large banks, and about 25% was in non-bank lenders, being mostly brokers at that time. That was kind of before the fintech bang, but that was where we were at 25, 50, 25. If you fast forward to 2020, you see that the small regional banks and credit unions have basically maintained their share, maybe dropped just a little bit. But where the big change has come in is where the non-bank lenders have taken share from the large banks in 2020. And through research that we've done, we know that that's been through focus on the customer, adoption of technology, and sort of this movement of more brokers in the space. And I know, Travis, for you, that's probably exciting on the broker front to see this market share change. But what's your reaction to seeing this change in market share, and what do you think may shift even more as we get beyond sort of the pandemic that we're coming out of now?
Yeah, it's interesting when I look at that graph. So when we talk the bookends, on the front part of it, I was with one of the biggest national banks at the time. I was with Wells Fargo when that started, right? And now here I am, as a broker. So it's interesting to see that I've been on both sides of it. But that is exciting to me to see this. I think I want to say I'm not surprised by it, because I am seeing the growth in the broker channel. There's a couple of big wholesale lenders that are supporting that channel and helping it grow. And they predicted this. They've put a lot of money and effort and technology into it, and we're seeing it. I think a lot of it has to do with consumers. We're seeing younger consumers. They want more transparency. They want more speed. They want all those things that really, that the smaller, more nimble non-bank lenders are going to be able to provide.
Yeah, interesting. So when you were at Wells, what was happening there? I'd be interested to know, like, were people sort of freaking out about what was going on? Was it like, let's pull back our spending? Do you remember? I mean, I know that was a long time ago, but.
Yeah, it was interesting because at the time, the problem was there wasn't equity, right? So we saw, rates were improving to try and stimulate the economy, but there just wasn't the equity position. I remember the HELOCs were basically non-existent. They'd cut them off, or people would want to try and get them, but they just weren't. Like today, everyone's getting a HELOC or pulling out cash or doing things like that, right? Because there's equity there. There just wasn't back then. From an operational standpoint, very cumbersome, right? Like just a slow, drawn out process and not consumer friendly. So yeah, it's very, very different to how we see things today.
Interesting. Well, I'm glad that you're on the side that's gaining the market share. Probably a smart move on your part. But as you know, big banks are going to fight back, right? So let's talk about sort of the future and sort of navigating the current environment as we go to the next slide here. So, what are the risks you see? And as we look at sort of refi versus purchase here, what are the risks you see of putting all your eggs into one basket, either refi or purchase? Some people argue that doing that, you can get better at one versus the other, or you can improve that operation. But do you see risks at sort of putting all your eggs in either the refi or the purchase bucket?
Yeah, for sure. I mean, there's an argument for kind of both sides of it, right? I mean, you can become an expert in one. I know people that do a ton of volume and that's their only focus. They don't try and, they don't try and focus on refi at all. And in a year like last year or the previous year, yeah, you're going to miss out on money, growth opportunity, but it may not be a problem, right? Like you may be such an expert in your kind of your niche there that doesn't matter. For me, I need a balanced pipeline. I went and pulled my numbers after you and I had spoke last week just to kind of see. I mean, in 2020, I was a little over 60% refi, and very, very similar in 2021. And then year to date, 22, I'm like 30% refi. Right. Oh, wow. So I've almost flipped them almost exactly. And fortunately, I mean, we have enough purchase business right now, but that's because during all of this, we were trying to focus on both sides of it. I think there's a ton of risk in going in, especially going in all refi. And I'm going to say that because when market improves as far as rate and it's a refi boom, you just see all this potential, all this money you can make, the growth, you can jump into it. The problem with that is you're at the mercy of the market, right? And you have no control over what happens. I mean, you don't have any control over the rate, Fed Reserve, what they're going to do.
Yeah.
And so it's great, why it's great. But as soon as that turns, that's a problem, right? And so it's scary. I mean, we knew it going into last year and 20 and 21, like, hey, we're making good money with refis. There's a lot of focus on this. But in the back of our mind, it was always there. I was probably more bullish about it than anyone else in my office, thinking rates aren't going to get that bad. And they did, right? So I was wrong in that. I knew they would come up. I just didn't know they would go as fast as they did or as high as they went. And I think all of us were kind of shocked by that. But yeah, you've got, in my opinion, and again, I'm in a smaller brokerage. I'm in one state. I kind of am in, I spread across a couple of counties, but I'm a pretty focused market that I'm in. And so I've got to have it balanced. It's the only way it works for me.
Yeah, interesting. I remember we spoke with a few experts a while back, maybe what was it, 6 months ago in our sales kickoff. We asked the question, what do we think rates are going to be like, right? And everyone said, oh, it'll probably come in at between 4 and 5 and level off at 4.5%. And then we just, last few weeks ago, we were at 5.25, even higher than that, right? So yeah, you're right. It jumped higher than we expected. I think it's starting to maybe level off and come back down a little bit, but interesting nobody can predict that, to your point. Nobody can predict where we're going to end up. I think most people thought we were going to be in the 4s, mid 4s, and now we're already past 5. So with that said, I mean, I have 2 mortgages. I've got one that's at like 3% and one that's at like 3.5%. And now we're sitting at over 5, right? Is there a case for refis anymore? Should you be spending any time? I know a lot of companies are like really going away from refi right now. Is there still a case for refis in the portfolio in your perspective?
Yeah, I think there is, right? I mean, you have to find them. They're harder to find. Last year, they just fall into your lap, right? You could basically throw a dart and figure out how to structure a loan and it would work and the refi would make sense. But now I still think there's always going to be a case for some refis, right? Going in and lowering your interest rate and just saving monthly payment, probably not happening right now as much. Unless you've been living under a rock and haven't done anything in years. But there's always going to be divorce situations, right? And so we see that. I mean, I'm still, 30-something% of my portfolio is refi right now. And so when we look at that, like, what are they? Well, they're divorce situations, some of them where, one spouse is keeping the home, they've got to refi it out of the other's name, or with as much equity as there is, we're looking at cash out refinances, right? Homes inventory is low. It's hard to find homes to move and purchase, or maybe you're in an area that you're established. You don't want to disrupt the family, the dynamic, the school system, whatever it is, but the home needs updating, cash out refis, right? A lot of people are going to be looking at home equity lines of credit and kind of that option if they don't want to disrupt their current mortgage and the rate they have. But otherwise, yeah, you could pull out cash out. I've had relationships with investment bankers, financial advisors that, they'll have someone that will pull their money out of a home, cash out, and invest it in other things, right? In the market and whatnot. So there's always opportunity there if you go and look for it. But it's just not as prevalent as it was. It's not as easy. But yeah, I absolutely have refis right now. And I think you need to still be, I guess, looking at that avenue and building those relationships with those referral partners.
Yeah, that's interesting. I think when I think of refi in my own lens, it's like, yeah, I just want to lower my rate. But you're right. There's a bunch of different situations where a refi is sort of necessary, like in the divorce case. Yeah, good point. So, all right, well, let's think about future-proofing your business then. When you think about that, we've got, how do you take control of your own destiny in this highly variable rate environment that we're in now? And what do you do to sort of like future proof that, to make sure that the stuff that you mentioned is outside of your control is at least somewhat something that you can react to with control? How do you think about that? Future proofing, just working this current environment of this highly variable rate situation?
Yeah. I think there's lots of options. First of all, I mean, don't get me wrong. If the market turns tomorrow, like I'm going to switch and try and go get refis. And all these loans that I'm closing right now, like we know they're high, right? Maybe 2 years from now, they won't be high. We'll wish, we had done more at this time, but we're also thinking, well, if rates come down, all these loans we're closing right now are future refis, right? So I think as far as like future proofing it, well, what's your drip campaign? What's your system to be in contact, stay in front of those clients, right? Someone's going to market to them. And if it's not you, then if they didn't have a great experience or they forgot about you or whatever, they're not coming back to you. So all these rates right now are potential refis in the future. Every client you close is another, layer of future clients by referrals, refis, another purchase, whatever it may be. So I think one, you've got to stay in front of those clients. The deal's done, the transaction's over, but staying in front of them, whatever that looks like. I've seen it so many times where we'll bring on a loan officer. They're coming from another place, or they'll run a system and then they'll switch to a different customer system, and they're starting over. And I'm like, you've been doing this 15, 20 years and you're starting over every time you make a jump, right? But you've got this huge book of business that you no longer have access to. You don't keep your clients, and sometimes you can't, depending on where you're leaving, but other times it's just poor management of customer base, right? So I think that's one thing. The other thing is in your sales cycle, it's the old adage of always be closing, always be selling, right? Staying in front of these people. But when we had refis and that was our main focus and there wasn't a ton of inventory and agents were just struggling to, get deals, real estate agents, I'm saying, because inventory was so low, it was easy for loan officers to forget about agents. And we would say it in the office and you'd hear it don't forget your agents, right? Go out there and you'd call them up and chat with them. And they're just, I got no inventory. There's nothing out there. It's so tough. And, we're getting undercut by each other and all these things. That's fine. You weren't going to get a deal out of it, but you were in front of them, right? You were staying in front of them. They knew you cared. I think that's important because then now when it changes and we're going a little more purchase than refi or a lot more purchase than refi, you don't want to be the person that's showing up looking like you're just open-handed waiting for, a deal. Like, where were you the last 2 years? You completely forgot about me. You ignored it. So I think you've got to future-proof it. You've got to, one, have a good experience with your clients so they want to come back to you. Two, stay in front of them. And then always be selling or making contacts, building relationships with these other referral partners, right?
Yep, absolutely. And I heard a story about you where you've told clients in the past that they should go with somebody else who had a crazy rate deal, and I know that you've talked about just building a genuine relationship where you're being honest with your customers and you stay reaching out to them. And I know that you do things to kind of stay in contact with them via email and via events that you guys put on. So really cool way to keep in front of your customers, even when they're not needing your services at the time. I want to ask one more question on the slide, but before we do, let me just remind everyone, this is our DOMA Ask the Expert series. My name is Devin Payne. I'm a director of product marketing here at DOMA. We're here with Travis Lemmon, who is a owner at Creekside Mortgage in Pleasant Grove, Utah. So again, thanks for being here with us, Travis. And before we move on to the next slide, I want to ask you one sort of personal question that I know about you is, Travis was about to close on a new piece of land with a new house that is a decent size, from what I understand. No, I'm kidding. I think it's a decent size, but it's. I know you were in that right in the middle of COVID, right? I think it was 2020 when that was happening. You had, I think, more than double digits, like 20 something deals in your pipeline, and all of a sudden everyone pulled back right at the same time, right? COVID, nobody knew what was going to happen. Everyone's like, I don't know what's going to go on with COVID. Are people going to be moving? Is my house going to, what's going to happen? and I think all your deals just sort of dried up, right? So if you can think back to that time a few years back, what did you do to recover from that situation, especially when you were buying, investing yourself, putting a lot of money down? Like, what was that like, and how did you recover from that?
Yeah, so I'll give a little backstory on it. So my wife and I have 5 kids. They're 5 kids within like 10 years of each other. So they're basically, 2 years apart. We range from 12 to 2. And we purchased the home we were in, and we're in until about 6 months ago, was about 1,400 square feet. So 3 bedroom, 1.5 bath, 7 of us. Not recommended for any family or marriage, but that's what it was. And so about 4 or 5 years ago, we bought a piece of ground next to us. It's contiguous to our home, but it was this old rundown, big piece of ground. It's about 2 acres, and had animals on it, and old shops and sheds and a house and whatever. Anyways, we closed on that. It took everything we could to buy it at the time. And then business continued to grow, and it was good and whatnot. And so about 1 month before COVID hit, like January, February of, 20, we had tenants in there. When we bought it, we had been renting it out for a while until we were ready to build. And I told the tenants, they had plenty of notice, had them come out, and the home was now vacant, and we were going to level it and build. And they moved out. And when we were going through the process, they were doing soil tests. We'd gone through engineering. We had plans. Like, we were ready to bring in the bulldozer and level it. And that's when COVID hit, right? And it was nerve wracking. It was those initial things of just like, you didn't know what it was, what to expect. And yeah, I lost 24 deals in 5 days, my entire pipeline. And so we shifted and pivoted here at the office. We moved people around, tried to isolate them, people working from home. Meanwhile, we have no deals, right? So from an owner standpoint, we kept everyone paid, everyone stayed on salary, stayed employed, but it was terrifying. We had lenders pulling money and kind of sitting on the sidelines. We had deals that were clear to close with lenders, and they would not release the docs and the funds, right? Wow. To where we were like, okay, so we pulled a loan and take it somewhere else. And it was just, they were so uneasy with everything. I mean, that's really, really frustrating. That's not a good customer experience. It's frustrating because you've done the work, it was done, and you were just held ransom. But that was kind of the nature of it, right? And it was only a few weeks, but yeah, we lost everything. It was terrifying. So that gives you a little backstory on how scary that was. Anyways, and then we started to see recovery quickly in this sector as far as, rates were improving. And then it kind of became the refi boom, right? Yeah. And so purchases, there was still some purchases that kind of didn't come back. People lost jobs, right? They no longer wanted to buy. They didn't want to move. We started seeing people realize they can work from anywhere and work from home more so than in the past. I mean, I closed a loan for an engineer for Ford Motor Company that was moving to Utah, right? Oh, historically, you would never be able to be outside of Detroit. Yeah. And he got approval to do that, and they closed it. And so we saw this influx of business coming into Utah, refis, purchase, all that. And it just kind of got crazy. But it was about a month of just sheer panic of what are we going to do, right? Wow. Fortunately, we had reserves. We were able to keep people on staff, and we had run a lean company so that, we still had the staff there and in place to support us when things started to ramp up. But yeah, that was, I don't know if that answered your question. Yeah, no, situation. I mean, we just had to pivot immediately and figure out a way to make this work.
Yeah, absolutely. I think, running a lean company during that time comes in handy when these completely unexpected events happen, and you need a couple months of buffer to figure out what just hit you and what you're going to do about it. So that's that's one of the big things I picked up out of that, is just make sure that you've got a few months of, let's call it emergency fund, to make sure that these big things don't really throw you under. All right, so let's, as we move over, let's think about, so when you shift back and forth between refi and purchase, is that a big lift on you, or does it because I know one, you're talking about different referral partners, right? With purchase, you're working with real estate agents, and what is the big shift as you go back and forth between purchase and refi? Is it the relationship building? Is it operations, the flow? What do you think? What are your best practices for kind of like shifting back and forth there?
Yeah, well, as much as you don't have any control over the market and rates, right? And so when you shift into a refi kind of market, that had nothing to do with you, right? But it's nice to be able to capitalize on it and jump it when the rates are there, and making sure that, at that point, like you're getting communication out to your borrowers, you're running reports, you're seeing who can save money, how much, and all that communication. That is really hard to do sometimes when it picks up and you start getting a lot of calls, you get busy, right? You've got timelines, you've got loans to process and go through, and yet over here you need to be marketing and going through that. That's what a team helps with, right? I mean, I have team members that's kind of what they do, is they focus on opportunities there, or they'll just run operations as far as processing, so I can focus on that, whatever it may be. When you shift to relationship selling, that's harder, right? Because it's a relationship. You're not going to go in and just get a deal immediately or win them over. They probably already have someone they're working with. So it's a slow process, and it's a grind. And that's why before I said, you've got to always be doing it, always be nurturing that relationship, regardless whether you're working with them or you need them right now or whatnot. You will need them at some point, right? And we tend to just try and play nice in the sandbox whenever. I mean, I always say it with my clients, I don't ever want to be embarrassed to run into them. You mentioned like me telling someone that was a better deal, right? Like, I'm not going to strong arm someone into using us. If there's a better deal out there and we can't beat it, they should go with that lender, right? Like, and hopefully it pays dividends for us in the end, the honesty and the transparency. But yeah, as far as shifting, like it is kind of nice sometimes, because the relationship stuff, you feel like you're, I don't know, a little on edge, not on edge. It's a relationship, right? You got to work at it. Whereas like, oh, so refi, boom, great. We're just going to have deals coming in, right? And that's in the last 2 years. Like, I mean, you're talking historically, people would drop 0.25%, half a point, something like that. You'd get a refi out of it. In the last run, when people were dropping like 2 points, like a full 2 percentage points on rate, you talk to them about dropping a quarter, and it doesn't make sense. Right. So we kind of got spoiled. So I don't know what it'll be like when it comes back, but they are very different. The relationship thing is a complete grind. You've got to constantly be nurturing it and making sure it's good. The refi, when it's there, it had nothing to do with you, but you better be ready to capitalize on it.
Yeah.
And if you are not doing that now, it's too late. That's the whole thing, is every time you close one, you've got to have them in your database. You've got to be tracking it. You've got to stay in front of them, whether that's, birthday messages, loan anniversary messages, drip campaigns, whatever it may be. Like, you've got to do that so they know, hey, this is my loan officer. This is who I go to.
Yep. Yeah. And I've seen that with you guys. I actually looked up your reviews before this, and you guys have, hundreds and hundreds of 5-star reviews. And so I can tell that the honesty and that you work with and just the relationships that you build are paying off in how others are talking about you and word of mouth and in reviews. So that's awesome to see that payback comes back to you down the road. And yeah. I know you've seen payback 3, 5, 10 years down the road, right? Where somebody that you worked with back when knows how you treated them and comes back to you. So that's really cool to see.
Yeah, I mean, I had a conversation with someone yesterday. They called in. They had some credit issues. They didn't have much of a down payment. And they said they had spoken with another lender, and the lender just never really got back to him, never gave him a game plan, this and that. And I immediately know why, right? Because they're not able to buy anything right now. They need to work on credit. They need to fix some other things. But we just said, look, here's my contact info. This is what you need to do. You're probably a year plus out in trying to do something, but great. We're not going anywhere. We're here.
Yeah.
Right. Don't charge you to talk to us, consult on it. This is what you need to go do. That's your game plan. And we feel like that pays dividends. If you're really serious and you're in this industry and and you've kind of gone through ups and downs, you know you're going to be here for a while, then you don't need to chase that deal and make sure it closes today, right? Like,
Yeah.
do right by people and it'll come back to you.
Yeah, absolutely. So it's that longer term vision rather than that short term one deal vision, right? Where you just need to get something done now.
Yeah.
You're the long term. Well, I just have one more question I want to ask before we open up for some Q&A from the audience is well, the last one is, so I know you were a loan officer and you moved to go out on your own. I'm sure that was a scary decision, but what sort of motivated with that? Was it to have more control over things like this? Was it something else? What caused you to make that decision, and how do you feel about it now?
Yeah. It was a good move now, right? Like I love it, wouldn't change it. It was scary when we did it. I remember when I made the decision to do it. It was like over a 2-day process when my wife was delivering our 4th child. And so I don't know, maybe emotions were high and we made that decision, but it worked out. It was good. For me, what it came down to is I was at the time when I first went out to like brokering and doing my own thing, not just being a loan officer and not an assistant, but it was because I was with a big national lender and they were great. They had lots of processes and different things, but there was tons of layers of management. There was a lot of marketing money and dollars spent on things that I didn't benefit from, right? At a national level, they did, but in my little market where I was, it just didn't translate and come across. And so what happened is I started quoting rates and realizing I know they can go out there and find a better deal easily, right? There's always someone that can do a better deal, and you kind of roll your eyes at it. You're like, yeah, it might be bait and switch, this, that, right? But like, I started to feel like, okay, I'm embarrassed to send this quote, right? And as I looked at it, I just thought, okay, this isn't for me. I wanted more transparency. I wanted better pricing. I wanted more control, those kinds of things. I can't control everything in a transaction, but I try to control a lot. Right. And so for me, it was just adjusting one more thing that I could be in control of. I could know that I was giving someone the best deal possible, feel honest about it. Going back to my comment of I don't ever want to be embarrassed running into people. It was actually my wife's college roommate. That was kind of the quote that was the straw that broke the camel's back. I sent a quote over, and as I sent it, I was just like, I know there's just too much meat on the bone here to pay for advertising stuff. For example, the company I worked for, they had like a MLB field, right? And there was all these things like, okay, I've never even been to this baseball field, doesn't benefit me, we don't care. And so it was things like that where it was too expensive, and I was really embarrassed by it. And so that was almost the day that I made the decision, like, no, I got to go do something. But I think we see that like in the market right now. I mean, you look at the younger generation, they grew up with Google. They want transparency, they want technology, they want all these things fast and now. And so that was kind of the move, right? This was years ago, but we're seeing that chart you showed up front. Like, we're seeing that trend go that way. There is a part of me that I'm like, will I be out of a job at some point, right? Like, will the art of being a loan officer go away? It will for sure be automated. I think there's always a need for loan officers and people. As much as we love technology, like, it's the biggest, most expensive purchase of your life. Generally, it's super involved. Like, you kind of need someone there to hold your hand and walk you through it and be your advocate. And that's what we're here for. But yeah, that's why we made the change. Just transparency, honesty, speed, having more control, all of those factors that for me, the broker channel was perfect.
Yeah, interesting. Well, thanks. Yeah, thanks for sharing that. That makes a lot of sense. I didn't really think about the fact that you sort of have to be the face of what somebody else was dictating as far as rates, and you had to sort of defend that position maybe, and maybe you didn't fully believe in it. So that's really interesting to hear. Thanks for sharing. Well, again, so this is our DOMA Ask the Expert series. I'm Devin Payne. I'm a director of product marketing here at DOMA. We're with Travis Lemmon, who's the owner at Creekside Mortgage out of Pleasant Grove, Utah. Thank you for being here with us, Travis, again. We have a few questions that my team has sent over to me. If you do have more, I believe you can put them in the Q&A, but I think a couple have come in so far. So I just want to ask you these with a couple minutes that we have left, Travis.
Okay.
Number one is, just look this up here. How do you keep your team motivated and not just focused on rates? I'm guessing rates is a pretty big discussion in your office every day. So how do you keep the team motivated when rates are rising and things look bleak? Any thoughts on that?
Yeah, I mean, we're always looking to grow and go capture business and things. And so there's multiple answers to that question. For me, with my team, my direct team, you know, we have sales incentives, we have trip incentives, things that we do. And so they track it very closely, more so than I do, because they want to hit those goals and those numbers and win those incentives, which is great. It's what they're there for. So we put things out there to keep them motivated. When it switches and rate goes up and you sit there and look at it and say, okay, you know, I have the conversation with the team of, hey guys, now we're just going to go, you know, we're going to pivot, right? You guys need to be better at operations. You need to run cleaner files. You need to be quicker on this. Take care of the problem so that I'm not putting out fires. When I put out fires, it limits my ability to go out there and talk to divorce attorneys, talk to financial advisors, talk to agents, referral partners, whatever that is, right? If we're not going to get business via low rates, we're going to go get business. So where and how, right? And I say it all the time, like my team doesn't make money by me sitting behind the desk, right? Like I'm the main one that brings in the production. They run operations with me on it. And so for me, I've got to get out, I make those calls, do the sales, whatever that is. And so that's kind of the focus we have is like, hey, let's not stress rates because we know that we have a diversified pipeline. We're just going to pivot and focus on this side. We're not going to forget about this either. So I don't know. I mean, I deal more with rate than they do, but we just try and make sure that their focus is aligned so that it helps me go get business wherever that may be at that point in time.
Awesome. Yeah, interesting. That sounds like the team is highly motivated and that they know their role. So that's really cool. Let's see, we got one more that's being sent my way. And we may have to close up after that unless there's another one that comes in, but it says, what in your opinion is the top reason a customer may choose not to work with you again?
Yeah. Well, you don't win everyone, right? Personalities conflict and things. And I hate that. We understand that, we know that. I have a really hard time. I have a little quote that I hang on my wall in my office. No one can really see it, but I see it by my computer that says, be responsible to, not for. And I think part of the reason I'm good at what we do is because we do care a lot. We care. I realize that on the other side of this transaction, there are people that are going to actually live in these homes, right? That they're going to have kids there, family there, all that. It is very disruptive when you move. I've had transactions that look like they may not close and people were moving and it's like, we don't want them homeless now. So it's not lost on me that there are people on the other sides of these transactions. And so we care a lot, probably more so than we should, because sometimes we cross that line of we start taking responsibility for our clients instead of being responsible to them, right? Lates on credit and things like that, or lost jobs or anything like that that can kill a deal or cause issues. Like, well, I didn't do that, right? But we feel responsible then to try and fix it and help it and whatnot. But that being said, it is a very, very invasive process. It sounds crude, but I say it all the time. Like a doctor sees you physically naked and we see you financially naked, right? Like we see every aspect of you financially when you go through this process. And so I think sometimes because of the nature of how that is, what's needed, it's a long process. It's invasive. It's frustrating. Like people will send me snapshots like, hey, here's a snapshot of my whatever, my tax return. It's like, That's a shadowed keystone copy of a tax return sitting on the front seat of your car. Like that doesn't work. I need a PDF like version of that. I need
Yeah.
to see it, right? And it's like, oh, well, this is it's 30 pages. Do you need all? Yeah, I do. I actually need the pages. Like, and so what happens is that process of just what's involved in it correlates to Travis asked for so much stuff, right? And I wish it were like, hey, we trust you. Oh, there's your pulse. You're alive. Here's your loan. It doesn't work that way. Like, and so I think sometimes the process of getting a loan translates across to people that it's us, and they would have a similar experience if they went anywhere, maybe worse, right? You talk about when people go somewhere else, or we'll tell them to go somewhere else because it's a better rate. In the back of my mind, I'm kind of like, that might be bait and switch, right? That might be super low rates for a reason, right? Like these people aren't experts. They don't know what they're talking about. They're going to drag you through this process for 90 days. You're still not going to close. You're going to risk earnest money, right? And it's like, okay, we hope to have it be a good experience, but we do make money doing this. And so we can't win every deal, and some people are going to go elsewhere. And we try very, very hard, but we realize that we're not going to retain 100% of what we close. We do retain a lot. Almost all of my business is word of mouth at this point.
Oh, wow. Okay. Well, this has been super fascinating for me. We really appreciate your time, and thank you to all those that joined today. We'll make this available as well. Doma.com is who we represent, and we're here talking with Travis Lemmon at Creekside Mortgage, who's an owner there in Pleasant Grove, Utah. Thank you all for joining us today. We're out of time now, but again, thank you, Travis, for your expertise and for your willingness to spend some time with us. And
thank you, Devin.
Appreciate it. Yeah. So we'll close up this webinar for today, but look out for more Ask the Expert series coming from Doma.com, and see you all later.